Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement here on the show. Our show is all about saving money, building up wealth, and understanding the world today. We put the show together to help people increase their savings, to get rich, to retire successfully, and then how to navigate through that. And the first thing you want to do is take charge of your retirement. Put away at least 10% of your income, plus a company match. That gets you about 13%. And so you aggressively save money, save aggressively, and invest conservatively. And then the 13%, and then you conservatively invest it. And we're understanding the importance of conservatively investing it in the world today. People that are invested in private debt funds and all these other fancy things are now in trouble. They can't get their money out. They're gated. The stock market is very volatile. It's falling. And so the conservatively investing is the important thing. And now is not the time to be gambling. It's not the time to be reaching for yield. Now is the time to be conservatively investing your money. So you take charge of your retirement. 13% is the number, 10% plus 3% company match. That gets you where you need to be. And then you can spend the rest of your money after that. But this gets you to the point that you can build up wealth. You can retire successfully and enjoy life and not have to worry about things. And then, as I said, the second part of that plan, save aggressively, put away as much money as you can. Remember, you're getting, every time you put $1 into a qualified plan, be it an IRA or 401k or 403b, you're getting back a percentage of it on your taxes because it's a tax deduction. Then it grows tax-free. And that's so incredibly important. I mean, the difference between, it's much tougher, we manage retirement money at Max Out Savings Advisors. We also have, non-retirement money. We have trust, different things like that. It's a lot easier to manage the money in retirement accounts because we don't have to worry about the tax consequences. When you get big gains in something, it's pretty painful to be paying the taxes on those. And if you're an IRA, you're not paying the taxes. I mean, it's an incredible advantage long term. The power of compounding is the greatest thing in the world. Well, the power of compounding and not paying taxes is an even greater thing. And so you want to position yourself and take charge of your retirement. Set your life up. That 10% is a small price to pay to sit there and when it comes time to retire, you get older, to have money to be able to enjoy, relax, go travel, do what you like, buy a new car, whatever, or not have to worry about things. And so it's not that hard, but it is so important to take advantage of these things and to change your life. Now, that conservatively investing, save aggressively, invest conservatively. This is the big thing that we talk about on the show. We talk about you should spread your risk. I think this is something we do phenomenally well at Max Out Savings Advisors is manage risk. We've talked about risk management, and we talked about the importance of it. We just sent out our most recent Max Out Savings report yesterday. If you didn't get a copy, check your junk mail. Sometimes it gets caught up in there. The spam folder, those things. But if you've not signed up for that, that's free. Just go to maxoutsavings.com. And we talk a lot of the issues. Really, the title of this one was Commodity Chaos, and it's pretty much what we're dealing with in the world today, and so here we are today with with the war, in history doesn't repeat, but it often rhymes. I mean, we had 9/11, and we ended up in a war in Afghanistan. In 9/11, and actually we had 9/10, and that was when Charlie Kirk was shot and killed last year. In both cases, they led to war. I mean, Charlie Kirk was one of the biggest proponents of not, going back to war in the Middle East, and once he was out of the way, we ended up here we are in a war. And look, the Iranians are clearly a problem. They've been a problem for us for nearly 50 years. They've killed thousands of Americans during that time. But we're in a war, and the war is taking longer than expected. It's not going as well as expected, and it's frustrating. I mean, listeners of the show know we're pretty optimistic. Started out the year, what we said is, look, the economy is going to be we thought was going to be very good this year. We've got but we said it's going to be volatile in the first quarter or so. First half of the year is going to be a lot of volatility, and that's been correct. But we said, look, we've got thousands of factories coming online or starting to be rebuilt. We've got tax credit, bigger tax refunds than normal coming in. We have low gasoline prices. We have, inflation is down. The wind was really kind of at our back, and President Trump has put together just a brilliant program to reshore manufacturing back to the United States. Basically, he took a page from the Chinese, and the Chinese figured out, well, we're coming out of communism. What do? We said, well, we need to hire our people. Let's put factories in, and then we'll export things overseas, and we'll just get the Americans' factories and move them over here. And that's what they did. And Trump said, well, look, why can't we take those factories back over here? And he put tariffs on them, and he's put rules and regulations to force the factories to come back to the United States. So we had a really good situation coming in. We had the AI build-outs. $500 billion in AI data center spending coming out. We had rebuilding of our defense. So we had reshoring of manufacturing. So we felt it was going to be a really good year. Later on, and again, we warned you at the beginning of the year, this market was going to be tough first quarter, first half of the year. But that's all kind of gone up in smoke in a way. With this war, we have higher energy prices. I'm looking at a gas station right now, $3.99 a gallon for gasoline. Diesel's $5.79, and so this is slowing things down. Where we had declining inflation. We had lower interest rates were expected to go lower. They're arguing about was the Fed was Chairman Powell going to cut on his last meeting, or was the new chairman Warsh coming in? Was he going to be the first person to cut? And now it's shifted over to are we going to have interest rate cuts at all this year? It's a 25% chance we even get any cuts. Interest rates have gone up. The 10-year is at almost 4.5%, 4.45%. This is a jump up, and so it's frustrating, because what we had a really good situation coming in is now we're dealing with the war that is not going well. I think they came in with overly optimistic projections. Iran is about half the size of the United States. It's a very large country. It's twice the size of Iraq. They've got 90 million people there, and we're looking at a situation where we could have 75 million people immigrating into Europe and all over the world as the thing is blown up, or we're looking at, does this thing accelerate? Are nuclear weapons involved in it? And I think the probability of some type of nuclear exchange are much higher than people think. Now, it's not 50, 60%, but it's not 5% either. And so, now we're looking at bringing troops in there. This is causing a lot of uncertainty in the markets in here. And so, a couple thoughts on this. We're starting to see some positives on this. We've been in this war for about 30 days now. almost a month. It started, I think, on the 28th of February. So here we are. From the day it started, I've got phone calls and listening to TV, the mainstream media. It's going to be over next week. And we've been hearing that. Then it got into, well, it may be 1 to 2 weeks. And this has been going on and going on. It's just about over. The Iranians are about to give in. But if you looked at it, that wasn't the case. We weren't really told about the damage that they were doing to us or to Israel or other places. I mean, it's against the law to even show anything at all what's happening in Israel. And even these other countries, they'll throw you in jail if you sit there in the Arab countries, if you show a picture of a missile exploding on something over there. But it's starting to leak out. So this has caused the problems are much bigger. Nobody counted on the Straits of Hormuz closing when they did this. The projections weren't there. The projections were, no one counted that the Iranians would strike the energy infrastructure of their Arab friends over there, quite frankly. But they did. There was a major attack on the Saudi air base that injured Americans and blew up numerous planes, including some special radar planes, in the last 48 hours. And so these things weren't counted on. So the problem we have right now is a couple things. Do we back out and just say call it a day? But the problem is Iran is saying, hey, we're going to put up a toll booth at the front of the straits, and everyone's going to have to pay us. And when we pull out the rest of the Arab countries, it puts basically Iran in charge of the Middle East, which we can't have that happen. And so we're in this thing now where something has to be done. And so a couple positives I've seen for the first time is one of them is Secretary of State Rubio said 2 to 4 weeks this thing should be winding up. They're finally extending out the time. And one of the problems we've been running into is we've been hearing this is going to be over for a week. Well, the Iranians are hearing this and go, well, look, if we can just hold out for another week, we'll be fine, and they'll have to come negotiate with us, and we'll win the war. And the problem has been, this has been the first war in the history that I know of. In the past, in major wars, oftentimes the stock markets were shut down initially. And in this case, the markets was open. Well, the market was open for the Vietnam War. It was open for Iran. It was open up, for Iraq wars. But the problem is, in this case, the market, the tail is wagging the dog. The market is really, the Iranians know President Trump is trying to hold up the stock market, and so again, they keep trying to do things to sit there and throw it off, and they're playing for time because they know that the president is under the gun to hold the market up. Well, look, that went off the table this week. And if you're going to fight a war, and it's the same thing with the midterms, look, you're in the game. You have a choice. You can either get the midterms and lose the war, or you can sit there and say, hey, we might lose the midterms, but we're going to win the war. And that's for the first time we've seen that talk of that this week. We're making the change to win the war. We're making the decision that, look, we're in this to win. The Iranians have to know that we're in it to win. We don't give a damn about our stock market. We don't give a damn about who gets elected at the midterms. We're in to win. This is a war. They're attacking us. They're attacking infrastructure in the United States. You're just not hearing about it. So this is a tough thing. Now, the other good thing is happening is Vice President J.D. Vance is going to be working with the negotiations. His star is kind of rising at the White House because he kind of said, guys, look, I'm not sure about this. I think this is going to be much tougher than people think. And there's evidently a pretty tough call with Netanyahu saying, you guys were promising this was a cakewalk, effectively, or we get over, and here we are. And so the fact that J.D. Vance is coming in, it's going to be a much cooler heads are getting involved in this war, and they understand the situation we're in, and they're more likely to, I think, to get a solution from the Iranians probably, or also convince the Iranians that we're serious about this war. Again, once we're talking about another month or two, we're hearing that from Secretary of State Rubio. They're understanding that, look, we're in there to win. We're moving troops over. We're moving another aircraft carrier in there. I think they rushed one of them out of startup to get over there. So we're moving 7,000 troops over. That's what you're hearing about. There's probably more than that. So the Iranians have to be convinced that we're in it to win it. Otherwise, realize this isn't going to stop. And for the first 30 days, we've not really seen that. And so this is changing. Now, this is going to affect investment markets. I want to talk about that after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking savings investments in your retirement, as always, here on the show. And you can give us a call at 713-339-1070. If you haven't had a chance to sign up for our free Max Out Savings Report, we write about a lot of these big issues. The most recent one just came up talking about the issues with the commodities. Just go to the website, maxoutsavings.com, sign up for the free reports. So what do we do here with the markets? And what we've been talking about on the markets here since the war started, we've kept pointing out since virtually the first time we pointed out, look, the market's not selling off. The market is too optimistic about what's going to happen. And up until a couple days ago, the market was off about 7% off the all-time high. That's the all-time high. And with a war going on in the Middle East, as we said, a war is going on in the Middle East. Interest rates are rising. Then they're not falling; they're rising. And oil prices were over $100 a barrel. Typically, anytime oil gets over $100 a barrel, we go into recession. And so, for the first time this week, we really saw a breakdown where people really started to see what was happening and to kind of understand what was happening. I mean, oil prices are still very high. If you look at the price of oil, it's about 114 or so on the for the Brent crude. In West Texas jumped up as well. But it's not just the problem we're running into is this war's going on for 30 days, and we have to look back and. At the beginning of the war. So the day before the war, the situation was this: oil was at $65. Well, it went up a little ahead of time, but $65, a couple of weeks beforehand, oil was going to probably going down to $50. That was what the talk was out there. It's going to 50. There's so much oil in the world. It's floating around. We have tons of oil. We don't know what to do with the oil. Well, when we went into this war, nobody thought the straits would be blocked, and nobody thought, especially that the Arabs, the other Arab countries' energy infrastructure would be bombed. Now, from what I'm hearing, it's pretty bad damage at the gas trains in Qatar. That there's a number of them are out. A lot of the other stuff isn't quite as bad in talking to some different people in the industry, but it's still going to take time. And the Straits of Hormuz have been shut for 30 days. What that means is all the oil in the world that's been sitting around in storage tankers in floating around in tankers, or maybe there were Russian oil that they couldn't figure out who to sell it to because everyone was under embargo on Russian oil. And then it was in storage tanks, or it was in salt caverns for a strategic petroleum. That was why oil was going to $50 a barrel, because hey, there's so much oil we don't know what to do with it all. That's come to an end now. All that oil, we've had 30 days of no oil coming out of the Middle East, and so all those tankers, people are desperate to get them. They're calling the Russians up. Yeah, we'll take the oil. Yeah, and it's not. A lot of that oil was trading at $140, $150 a barrel on those tankers, because they needed the oil. They needed the oil in Tokyo. They needed the oil in coming into Shanghai. They needed the oil wherever. I mean, one of the reasons oil's going up in the Houston area is because they're taking the oil. They're taking jet fuel and gasoline and diesel fuel, and they're loading it on tankers and moving it out through the Panama Canal to try to help out the Asians that have, many of them are 70% of their production, of their usage or more comes from the Persian Gulf. There's lines there's gas lines in Thailand, in the Philippines. There's shortages. There's price controls put in place. It's a severe situation, but it's not just oil. So we've got 30 days of oil shutdown, LNG. 20% of the world's LNG comes from Qatar. Well, that's shut in right now, and some of it's blown up. We can't get that out. In addition, about 25% of the LNG tankers in the world are trapped inside the Persian Gulf, which means they can't get it. There's only so much they can move around out there. And keep in mind, one thing with LNG, which is liquefied natural gas, is there's not a bunch of storage in it like there is. You see all these, you go to the airport or you see a refinery, there's big round tanks. That's all oil. The LNG has to be stored in very expensive tanks, and so they don't have huge amounts of it. Some of the countries only have 20 days or 15 days of LNG storage, which they're using up now, and so that's a problem there. If you look at some of the things with fertilizer, it's another situation where fertilizer prices, same thing. 40% of the world's fertilizer comes from the Persian Gulf. If you look at 45% of the world's sulfur exports come from the Persian Gulf. 25% of the world's ammonia comes from the Persian Gulf. It's all shut in. So where are we getting? 30% of the world's helium is comes out of the Persian Gulf. Now you said helium. What? Look, I don't need any balloons for my party, Dad. But helium is used for semiconductor production. It's one of the key. They need it for semiconductor production, which means this could slow down the semiconductor fabs around the world with the shortages of helium. The biggest producer in the world, fortunately, is the United States. The United States has not really hurt that much by this war. Now it's costing us $200 or $300 billion probably before it's over. It's done massive damage to our view in the world, because people are like, hey, you guys started this war. Now we're, in Japan and in Korea and China and Australia, all over the world, in Europe, they're getting hit with huge energy costs. But I want you to understand, it's not just oil. It's natural gas. It's helium. It's fertilizers. It's ammonias. It's all types of things. It's diesel fuel. It's jet fuel. All of that comes out of the Persian Gulf. Gasoline, and so these shortages are spreading around the world. And if this war ends tomorrow and these things come out, it's still going to be months and months and months before prices go down to that 60, not months, excuse me, it's going to be years before it goes back down to the $65. And so we're dealing with a very complicated situation that's gotten a whole lot worse. And the issue that I'm seeing is, and this is something that we talked about, is you really have a market that is that's really been in a dream world as far as the what really is happening in the world. I mean, if you look at the S&P 500, it's just now started to go down, and so I think there's a lot of risk out there. This is why we talk so much about risk. We put some hedges on. We cut them a little bit earlier in the week. But we've been able to navigate through this very well for our clients. I mean, knock on wood, but it's we're actually up year to date, and it's because we've had higher levels of cash. We've had the We've talked about the oil and gas. We thought it was going to be, we said even natural gas, when it was 65, we said natural gas is going to be a play because of the AI centers. And so we've been very fortunate in our placement. And then we've been able to use some of the declines to pick up a few things cheap. And even now I'm kind of reassessing some of that because I think we have to kind of see where this is all going to go. But if you look at the market, the market broke that 200-day moving average, which is something we've been saying it was going to do. Is we've been saying that look at it, around that 6,600. We said look, it keeps trading between the 100 and the 200-day moving average. I mean, looking at the chart, this is a really bad chart. Candidly, I mean they've got to come up with some real positive news Monday morning. By Monday morning. Otherwise this thing is going to go lower. It's as we talked about endlessly. The market was trading between 100 and trying to go up. We kept saying it, which is about 6,800. We said that we thought it was going to go and test the 200-day moving average. Which these are technical things. That there's crossover the moving average on the 50 days crossing over the 100-day moving average, and these are complicated, technical things, but when things start going wrong, it's something I've talked about on the show, when things aren't working, when your stock isn't going up the way it is, it starts dropping. The thing to do is to look at the technical indicators because they will often tell you, it's like, well, why isn't it going up? Why isn't it going up? It's really good news. Supposedly the war's about to be over. Why does the market keep going, slowly drifting lower? And then it hit the 200-day and it broke underneath it and went up and touched it again, and then it touched it again and it fell apart. That's not a good chart. I'm not even, that chart looks like 1987, and so. I mean, I think you still have to be cautious in here. I think you have to sit there. You don't have to sell everything because the thing could get solved tomorrow and you could get a huge run-up. But everyone's been hoping for the big run-up. I mean, I was talking to a friend of mine Friday, and I said, look, if we'd be in a World War II right now in this world, the Japanese would be bombing Pearl Harbor, and then a week later the investor would be running around buying stocks, to take advantage of the end of the war. And the World War II lasted 5 years. Vietnam lasted, 10 years. These things, I don't think this is going to be the case here. But we don't know, and people have just been way too quick, to sit there. And I mean, it's like, hey, well, you always, we're going to get to the other side of the valley here, and look, it's paradise on the other side of the valley. But what you don't realize is there's a couple different roads. Some of them are pretty easy to get through the valley. Other ones, it could be a nightmare, and you don't know what that road is going to be. And that's where we're at right now with these investment markets. And that's why, again, that broad-based portfolio we talked about, not just 60% stocks, mostly in S&P 500 and 40% long-term bonds. That's not going to get you. Have to be in stocks, you have to be in bonds, you have to be in commodities, you have to be in precious metals, you have to be in cash. With the cash, when the market starts falling, instead of going, oh my God, what am I going to do? What can I sell? You're looking at, where's the opportunity? And that fundamentally changes your psychological outlook of your investment portfolio when you have that ability. And this is why I've been talking about, we looked at the amount of cash on our clients' have. It's quite substantial. Up until about 3 weeks ago, the mutual fund, the investors' cash levels were about 1.1% in mutual funds and different things. That was near record lows. Well, it wasn't record lows, but it was the lowest in close to 8 to 10 years. And so these guys, when they're getting the sell orders, are all going to have to come into this market and sell stock. So rather than the funds looking around, hey, what is the opportunity, they're having to sell stuff to pay off investors. So again, this is why we spend so much time on the Max Out Savings Show and the Max Out Savings Report talking about the importance of risk management. I think we're one of the better people out there. I won't say in the country, but we got a really, really good record of dealing with very, very tough markets and navigating through, way ahead of anybody else out there. And this is something I just learned from some of my mentors years ago. One of them was one of the top strategists on Wall Street, and the guy was just brilliant. And you pick up at these things, and so in this environment, this is why we've been talking about this, for weeks, and actually even talking about the volatility coming up. The other thing is that's happening is the Mag 7 is really broken down. And again, this was another area we said, look, we've been talking about this for at least a year. These Mag 7 stocks are too expensive on a valuation PE, but also more importantly, the market cap valuation on these companies are way too big. They're engaged in massive stock buyback programs, and they're not going to be able to keep the prices up. And what happened? A couple things. They started going into AI, and all of a sudden they need to spend hundreds of billions of dollars on AI. Well, if you're a company, you have cash flow. A year ago, companies had hundreds of billions of dollars of free cash flow. So they're busily paying a little bitty dividend and buying back massive stock. Goldman Sachs stock buyback desk was probably one of the more profitable things out there. I mean, they're just buying back stock every day. If the market fell big, and the volume came in, well, the next day Goldman Sachs, would increase the number of shares the company would, Apple, Google, Microsoft would buy back, and would kind of prop it up, and it would keep going up. And so, well, all of a sudden they've got to spend hundreds of billions of dollars on AI, build out on AI plants. So what happens is, their chief financial officer goes, well, look, I can't. We got to cut back. You need how much, from their engineers? Well, you need $100 billion this year. Where am I getting this? Well, why don't you cut back the stock buyback program? That's what they did, and so their stocks have been selling off. Most of the tech companies, they really peaked back in September of last year. Some of them in July of last year. And the other thing that's happened to them is you had 7 big companies, and Tesla's a little different in a way right now, but you had 7 companies. They all had their own little moat. So Microsoft had Microsoft Office, Microsoft Windows, all that type of stuff, and Google had Google and search, and they dominated search, and then Facebook had Instagram, and they had Facebook, and that was super profitable. And you could just go right down the list of the different companies. Amazon was into data storage and different things like that. They each had their own little moats that they were doing. Oracle had Oracle Suites, and well, all of a sudden, with AI, they're all competing for the same pie. They're all building data centers. They're all building out chatbots. They're all building this. Well, the problem is they're all competing each other. So before they had these little moats, these little islands surrounded by a moat that nobody could penetrate, they had these. All of a sudden, they're fighting it out among themselves. Those are fundamentally different companies than they were a year ago. And this is why you're seeing the breakdown of many of these stocks. I mean, Microsoft has been disastrous this year. And if you look at Google, Google's done better, but they were just hit by a lawsuit, saying that they've been addicting kids. Well, hello, everybody knows that. And so you're starting to see these companies sell off in here pretty substantially. Google was one of the better ones. Supposedly it was going to go up because they had the best chat bot out there, which gone from $350 down to $273. And again, we if you kind of could stay out of them, you were in much better shape. Remember, in a crisis, when things change, when things go badly, the number one, one of the things that's helped me out over the years more than anything else is when something goes badly, kind of just step out of the way versus trying to bottom fish. And so technology is selling off as well. So we've got a lot of things that are coming in and happening in this market right now. So what? I'm up here against the break. We'll be right back. Going to talk some more about this and where things go, what we think is going to happen at this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
I'm Ted Gioka, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Gioka can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 1033. The Answer.
I'm Ted Gioka, and I approve this message.
Max Out Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or MaxOutSavings.com. Remember, you can hear the Max Out Savings program right here Saturdays at 10 a.m. on AM 1070 and FM 1033. The Answer. This is the Max Out Savings Minute with Ted Gioka. Ted's philosophy is save aggressively and investing conservatively. Ted, what do you mean by this?
Chuck, the key to that is that you want to save as much money as you can, so you aggressively save money, and then you conservatively invest it. And you start with your company plan, your 401k, your 403b, the different qualified plans. You invest a minimum of 10%, plus they give you a company match as well. And let's say the company match is 4%. So if you invest 10%, they give you a 40% return, which is 4% extra for investing. That goes into your plan. It grows tax-free over the long term. That is the easiest, the simplest way to have a successful retirement.
And you don't touch that money either. You let it stay there no matter what your situation is. You leave it alone, correct?
Yeah, that's correct.
That is what we talk about on the Max Out Savings with Ted Gioka Saturday mornings at 10 o'clock right here on AM 1070 and FM 1033, The Answer. So join us. Ted, thank you so much. We'll see you this Saturday.
Thank you, Chuck.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We're talking savings, investments in your retirement. Our motto and our philosophy is to save aggressively and invest conservatively. So we talked about earlier in the show, markets like this is why you invest conservatively. And one area that where people weren't investing as conservatively as they should have was the private equity fund, private debt. Yeah, and this private debt is just companies that are typically banks lend out money to smaller and mid-sized companies, and they go to the bank. Well, private debt people got in there and they borrowed money and they lent out to the same companies but at better rates, and then they got more aggressive with the rates. And so then they set up funds that you can invest in, but you could only get 5% of your money out each quarter, which wasn't a bad deal because, you know, candidly, if you're a player and you got a lot of money, you know, you should be able to handle it and stuff. But what's happened is the private debt, because of the AI, is wrecking a lot of small software companies that have lent heavily to private debt. And now oil prices have gone up, which has compounded the problem because many of these companies have big energy costs. Some of them are in trouble out there, so everybody wants their money back. And so we're seeing a run on the bank. Literally, it's like a run on the bank in private equity. Everyone's calling up their advisor or their broker and saying, look, you got me in this thing, get me out now. And so it's okay, we'll put you in. Well, all of a sudden they put it in, and, you know, instead of 5%, 8, 10, 15% of the people want their money out. And they said, well, look, we're just prorating. We're only taking out 5%, and you're getting prorated out. Well, when people see that, again, it's like the run at the bank. Whoa, what is that line at the bank doing? I don't know. Everyone's getting their money out. Then you go, well, maybe I should get my money out too. And so more people are wanting out. So we've had additional private equity companies gating their assets, saying, look, you can only get 5%. We're not letting anyone out any more than that. Now, keep in mind, it's 5% a quarter. So by the end of the year, you get 20%. 20% of the fund goes out. Well, this means a couple things. None of the big private debt people out there are lending right now. Well, they are, but they're lending at very high rates because the problem they're running into is they're just trying to get money off their portfolio, sell some of their loans off so they can get cash to give back to their investors. So this is tightening credit for small and medium-sized companies across the board. We saw the same thing back in the 1990s, I believe it was, with Michael Milken and junk bonds. He says, look, he did a lot of research, and he said junk bonds were actually pretty good. This is bonds rated below investment grade. Well, the reason why is because little companies, if they took a loan, they were trying to grow their business. It was pretty good. It was never set up so private equity or people taking companies private could go in and lever the companies up. This is a repeat of the junk bond fiasco of the 1990s, and it's spreading. So again, we have war, we have private debt crisis, all these things, and now we have rising interest rates. Last week, the 2-year hit 4%. It's down a little bit. I think that's 2-year treasuries. That's not a bad place to be to go collect 4% right now, because likely if this war continues, we could see, rates go much higher, but likely is if the economy slows, you could see them cut the shorter term rates. So probably the safer play is going to be the 2-year. And more than anything, longer term, you don't know what's going to happen with the war, but the 2-year is in a reasonably good shape. And we've talked to some people, our clients, they have they'll call us up, and if they have investments elsewhere, they'll ask us questions, and we try to give them an answer. We have a number of questions on CAD. I've got CD. What do I do? I said, look, get your CD. Don't do a 6-month CD. Do a year CD or an 18-month CD. Lock in the rate, and it could go a little higher, but the chances are it could go lower. And so I think that's one area that you can look at in here closely as well. We get a lot of calls about precious metals. We've been big believers in precious metals over the last 5 or 10, probably 10 years, which has had a phenomenal return. Recently, it was actually exceeded the S&P 500 returns over almost a 10-year period, which is just incredible. But it sold off some. And the question is, what are we dealing with? We're dealing with leverage, and we're dealing with some people out of the Middle East dumping gold or selling gold to raise cash for various things. I've got a little different take on this. Look, if you listen to what Secretary Bissett says, he said is we're going to deprive Iran of all. We've been working to deprive Iran of all their funding sources. This is through the different the different types of regulations that they put in place to stop them, sanctions, those type of things, so people won't do business with the Iranians, and so they have to sell their oil at a discount. Those type of things is what they've been doing, and so, Iran has built up a big gold stockpile, and they're moving gold around to block the sanctions. So I think there's a real possibility that the U.S. or some countries are trying to push down the price of gold to deprive Iran capital to fight the war. And this is something that we want to watch closely. Now, one of the things that did happen, if you look at the market on Friday, gold was up about $115, over 2.5%, which is a big move. And if you look at the S&P 500, that was down 1.6%. I mean, and the S&P 500 completely broke down Friday. I mean, it broke down early in the week. It touched Wednesday. It touched the 200-day moving average, and then it fell, and then it's kind of cascading down. Gold is turning up, so I think there's a possibility that the gold stabilizes in here, and then we'll have to see what to do with it. But that's kind of our read now. We've sold off some at higher levels, and we sold some of the stuff. We had just such huge gains, we just can't sell everything. It's just because the tax situation for our taxable clients is just ridiculous. So that's kind of my read there. I think the other thing we talked about in the Max Out Savings report with the tech sector is it's going to be important for growth stocks, and particularly tech, is going forward, is is that we're going to need to see here's the question. Who is in the past and who's the future? Who is a growth stock of the past and who is a growth stock of the future? Remember, Cisco topped out at like $85 in 1999, ultimately went down to like $18 or something like that. It wasn't the future. Now it's kind of come back up. So the key is, who is the future here? Now, you as we talked about earlier in the show, you have the Magnificent Seven with the moats around them, and those moats are all vanished. They're crumbling because of AI. They're all scrambling for the same bit. So who are going to be the winners and who are going to be the losers? We've seen stuff like Adobe and stuff. Those are the obvious ones, but they're starting to think some of the big mag tech are as well. So if you're going to invest in a sector, you want to be, or a growth side, you want to be in who are the guys that are going to sit there and win from this. We're in a defense company, a smaller one. It's kind of a high growth. It sold off a little this week, but these guys make the critical parts for a lot of the missiles and everything, and so they're key, and we're going to have to be building those for the next 10 years, so we're pretty confident of that. But some of the things with cybersecurity, we like that, but we're still kind of not. But you have to ascertain who is the future and who is the past, and I think that's going to be a very critical thing when you're looking at these growth stocks that have all plunged. And by the way, Tesla's a little different. Tesla's got we're not in Tesla at the present time. We're watching closely, but Tesla has the robotic car coming out. The robotaxi is going to start mass production later this year, and they're robots. And so I think there's another leg to Tesla. The other ones are much tougher. As the market sells off, the value stocks are going to be some of the things. Again, you've got to determine the value stocks, is it real value or not? And I think that's going to be another one of the critical things to look at with this market. And we have to see. The other thing we want to watch in here closely is with this war is a couple things. As we said earlier in the show, the war is not going well. I mean, let's be realistic about it. This was supposed to be over in 2 weeks, and it's not. Here we are a month later. The Persian Gulf is shut down. There's been damage, particularly to some of the LNG trains in Qatar, and there's shortages of fertilizers, chemicals, distillates like gasoline, jet fuel, diesel, not to mention oil, all over the world, and it's spreading. So it's not a good situation. So a couple things. How soon is it going to be over? Are we going to have peace talks? The other critical thing is, what is China going to do here? Again, does this spread? The concern you have with a couple of the key players, Iran and Israel, and actually, frankly, to the United States to some extent, there are people in there that are pushing this thing forward, thinking it's going to bring out the Messiah, the second coming, the Mahdi, whatever the Iranian thing is. And that's a very dangerous situation. Remember, Iran is run by religious fanatics. And even Israel, to a point, they're in there to some extent. And it's some of the people around the president as well, even on the Christian side. And you can't you're not going to predict that. I mean, history is full of this is the end times out there, and so you're not going to predict that. And so if you're trying to force the second coming or whatever, that's going to happen on God's time, not ours. And that's something that is kind of a concern on all sides of this war. And so we have to kind of see how it's going to play out. Are we going to get the peace talks? I think it's a real positive that if J.D. Vance goes over there, because I think this is a person that's been a little more skeptical of the whole thing, and I think it's got a huge base in the United States, and the president trusts him, and so that's a real positive there. And again, China's been awful quiet here. The United States isn't getting hurt by this war as much as diplomatically we are. It's a disaster, but compared to the rest of the world, China is in a world of hurt. They get a lot of their energy out of the Persian Gulf. We really don't. So what are they going to do? And so China can maybe come in and pressure Iran. And so these are some of the things we want to watch. But the question is, where does this market hold up? And do people panic and start cutting and running? And we're going to find that out over the next week or so. And so, again, I think you want to have cash. You want to be able to navigate through that. As I said earlier, I think 2-year treasuries aren't a bad place to be, collecting 4% or close to it, or bonds, again, short-term bonds. Listeners show know that, look, we like corporates, but our philosophy is, and this is very unique, is we believe we look at high-quality corporates, and we look at, hey, if we get a depression or a blow-up of the whole, will these guys be around? And that's kind of what we try to figure out, those type of companies. Hey, we might lose money, but we're going to be way ahead of everybody else out there. And I think that's a very unique stance. And so when we look at AA or A, or particularly AA bonds, we're looking, can it withstand that? And so there's a lot of AA and even some triple we won't touch, because we think, well, if something really goes wrong, they're not going to be AA or AAA. So again, we like the shorter term bonds, because with $39 trillion deficit, remember that deficit was supposed to go down. Again, we talked about at the beginning of the show. We had declining interest rates. We had $65 oil. This is all changing, and now we have rising rates. We had a declining deficit. Now our deficit is probably going to be another $2 trillion. So things could go wrong. And so you want to have that defensive portfolio. A couple things. Well, one of the ways we can help on the Max Out Savings Show is we send out a free newsletter. It goes out once a month talking about these issues. We're going to try to get another one out pretty quick here. We sent the other one out Friday. Check your spam box if you didn't get it. Just go to the website, maxoutsavings.com. Sign up for the free newsletter. It's completely free. We're not going to bother you. It's a private list, and we send that out. If you need help managing your retirement, if you're concerned about what's happening in the world, that's what we do at Max Out Savings Advisors. We're very, very comfortable in these type of crisis world in navigating through them. So if you need some help, if you're retiring, have an old 401k plan, trust or something you need some help with, just go to the website, maxoutsavings.com. Drop us an email at ted@maxoutsavings.com or give us a call, and we'll set up an appointment here in Houston, Texas with you, and I'll go over your situation and show you how we manage money. Until then, remember, the key to building up wealth is to save aggressively and invest conservatively. Again, we're seeing why the word invest conservatively comes in, because in times like this, that's when you want to be conservative. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're all